I guess the question is, what was the purpose of the stimulus package in response to the crisis of 2007, 2008? There is a long-term view and there's a short-term view. If your number one concern is to rebalance the economy away from excessive reliance on investment and on exports, net exports, the fiscal stimulus package doesn't work, because what it did was it took China from having the highest investment rate probably in recorded history and significantly increased it. It increased the importance of investment in China, and it increased the probability that a lot of this investment was not economically viable. What didn't go into infrastructure investment went into expanding capacity in a world that doesn't really need more capacity. We need less capacity. So it went into expanding shipbuilding and iron and steel production and chemicals, etc. So from that point of view, it's not been very successful, especially if you consider that there may be a significant increase in non-performing loans and in non-economically viable investment, which must be paid for in the future by the household sector, probably in the form of very low interest rates, which means that it'll act as a constraint on future household income growth and therefore a constraint on future consumption growth. So in a way, part of the expansion is going to push up production, and part of it is going to constrain the growth in consumption. And we already produce more than we consume, so pushing them in opposite directions is not going to help. But if you think that the purpose of the fiscal expansion and the credit expansion was to address a short-term problem of a surge in unemployment in China, then it's been extremely successful. With the collapse in net exports, we should have seen the economy grind to a halt, and we should have seen unemployment soar. And the purpose of the fiscal stimulus program was to address specifically that problem. Unfortunately, you have a conflict between the short-term policy objectives and the long-term policy objectives, and the government perhaps properly addressed the short-term policy objectives. But that doesn't mean that we have resolved the long-term rebalancing problem. We have probably made it worse, and we're going to have to rebalance one way or the other. In the case of China, rebalancing has a very special meaning. It means that consumption must grow as a share of GDP. To give you an idea, 5 or 6 years ago, consumption was around 40% of GDP. Private consumption was around 40% of GDP. That's an extraordinarily low number. I did some quick rooting around in numbers among Asian countries that have traditionally had high savings and low consumption rates. And I saw that Malaysia, which had private consumption in the low 50s, at one point after the crisis, it declined to around 45% of GDP before climbing back up to around 51, 52%. That 45% was an anomaly. Well, China 5 or 6 years ago was at 40%. And you have to bear in mind that the larger the country, the less likely the less likely it is to be an outlier. So 45% for China would have been worse than 45% for Malaysia. 40% for China was much, much lower. The government at the time decided that it was very important to raise consumption as a share of GDP. But because I believe they had the wrong model for thinking about it, what ended up happening over the next 5 years was that consumption as a share of GDP actually declined from 40 to 35%. So it's not easy to do. What do we need to do it? My model, my way of thinking about it suggests that consumption is a very low share because household income has been growing more slowly than national income, than total production, which is equal to national income. And the reason for that is because national income has been subsidized via very low interest rates, via an undervalued currency, via sluggish wage growth, and to a lesser extent by the deterioration in the social safety net and environmental degradation and one or two other things. But the first three are the most important. And all of those subsidies have to be paid for by somebody, and they're paid for directly or indirectly by the household sector. That's what's kept production growing faster than household income, which has meant production has grown faster than consumption. And you've got to either eliminate those transfers or better yet, reverse the transfers. But to do that means undermining the profitability of infrastructure investment and of large companies in China. undermining them to such extent that they may be running fairly significant losses. So it cannot be done quickly. In order for China to reduce its trade surplus, we need not that consumption grows. Everyone says that we need Chinese consumption to grow. Chinese consumption has been growing very quickly. In the past decade, it's grown around 8 or 9% a year, which is a much faster growth rate than in any other major economy. But that's not enough. The problem is that Chinese production is growing faster than Chinese consumption, so the gap between the two is increasing. Why is it growing faster? I would argue that the reason it's growing faster is because Chinese consumption growth is more or less in line with the growth in Chinese household income. So that national income, that is the total amount of stuff that China produces, is growing faster than household income. And the reason for that is that the development model China has followed, the very successful Asian development model, one of its key components is that the household sector, via low interest rates on their bank deposits, via an undervalued currency, and via a number of other mechanisms, are effectively forced to subsidize producers. The simplest way of thinking about it is through interest rates. With interest rates so low on banking deposits, that means basically savers are getting a portion of their income taxed away. Those low banking deposits translate into very low lending rates that are well below any definition of what the natural borrowing cost should be in China. So users of capital, which are mostly infrastructure investment and manufacturers, are getting very, very cheap capital, and that cheap capital is being subsidized by the household sector. So unless you reverse this process of subsidy, it's very, very difficult to get household income to grow much more quickly, and therefore consumption to grow much more quickly. And that's the problem that we face, because if you do eliminate the subsidy and even reverse the subsidy, the manufacturing sector, which is very heavily dependent on these subsidies, becomes very unprofitable. So we can't do it quickly, because if we do it quickly, we'll see a rise in unemployment in China. We have to do it slowly over 6, 7, 8 years. It won't be easy, but if it's stretched out over many years, it can be done. The problem is, if the developed world, if the trade deficit countries want a very quick resolution, then China is in a very difficult position because they cannot resolve it quickly. We will probably see very good growth again this year. You can get any level of growth you want if you put in a significantly high investment. If the United States wanted to, it could achieve 6% growth next year. We wouldn't do that because it would involve a huge increase in debt, and the growth itself would be very, very inefficient. And that increase in debt, since it must be repaid at some point in the future, will end up representing a contraction in the ability of U.S. households to consume. So whatever debt we get, whatever growth we get today, we'll give back more than 100% of it in the future, unless the investment is all appropriate and economically viable. So in the case of China, we are probably going to get another good year of growth. People talk about a significant contraction in the amount of lending. Well, it's not a contraction in the amount of lending. The typical amount of lending, annual lending for the last 5 or 6 years, has been between 3 and 4 trillion RMB. Last year, it was above 10 trillion RMB, an extraordinary number. This year, the target is 7.5 trillion, which many people are hailing as a significant tightening of policy. It's not a tightening of policy. It's a very, very loose policy, but much less loose than what it was last year, which was extraordinarily loose. So the question is, how many years can they keep doing this? And that, I would argue, is really a function of debt capacity. Unfortunately, we don't really know what the true debt levels are of the government. It's something that we're all working on trying to understand. And if government debt levels are sufficiently low, that means we could do several years of this in the hopes that eventually the global economy recovers and China can once again use net exports as a way of absorbing all of this capacity. But we're not sure that that's likely to happen. We're not sure that the global economy will recover. More importantly, that U.S. consumption will begin growing much faster than U.S. production. And B, we don't know what the debt capacity is, how many more years we have of this.